Hey team, it's Walker Dybel, author of Buy Then Build and creator of the Acquisition Lab. Lately, in the last week and a half, we've had some members asking about how to start a fund, right? Like what are the fund fundamentals? How do you put one together and how do you actually do it? And so I wanted to put together a short presentation just going over at a very high level what a fund is, what the benefits are, and how to do it. Okay. So first, here's a brief agenda of what we're going to cover today. Why start a fund? Why invest in a fund? In other words, I want you to understand why you would invest in one so that you can understand how to sell it to your investors, and why people are going to invest in you. The types of funds that there are, the types of investors, okay, the different classifications, the different structures, and then three steps that I think is the best way to actually go forward with starting one, okay? So why would you start a fund? Well, I mean, the truth is that the financial industry is one of the largest industries financially in the world. And the private markets, okay, the public markets are things like the stock exchange and whatever else. The private capital markets are, buying small businesses, even real estate, and the behemoth is, of course, private equity. Okay, and so a fund is a way that is the vehicle for the private equity industry and how private investors and really rich people are able to get exceptional returns. Okay, that's either through private equity used to acquire privately held businesses or real estate syndications where they're taking out multiple say multifamily properties, or your fund can really invest in anything. Okay, you can buy e-commerce businesses, you can buy tax liens, you can buy private companies, any of these types of things. Okay. And the biggest lever here is OPM, or other people's money. Once you get people to invest in a fund, the thing is that you're not raising capital for, say, one startup. Okay, you're raising a venture capital fund that then gives you authority to sort of allocate those funds as you see fit. Okay, so you're sort of addressing the need for the capital raise up front, and you're funding multiple deals at one time because you're funding the fund, right? And the thing is that people invest really behind a defined investment thesis. So if you're able to raise around your investment thesis, you then have the authority to allocate and distribute those funds as you see fit. Okay. And I think the big thing is that if I put in let's just say $100, and you pay me back $108, I made an 8% return on my $100. But if you put in $100, okay, and then I pay you $108, but then I then get $8 on top of that, I just made $8 on a zero investment, which means I received an infinite return. Okay, so it's a way to sort of play the financial game where I get to use my equity, my time, and my expertise to make infinite returns on other people's money. Okay, that's the underlying reason why people want to start a fund, and why you might be interested in learning to do it. Why would people invest in a fund though? Okay, because it's profitable. That's why people want to invest in a fund. If you run a fund and it's unprofitable, you are irresponsibly destroying value of other people's money. Okay, so don't start a fund just because it's got OPM and you're in it for you. Okay, you need to put your investors first. That's what I believe. Okay, and the thing is that, like, I have been able to be successful really by gaining over time kind of specialized knowledge in an inefficient market. Okay, and so people want access to that, and people want to know, like, okay, Walker, this is great, you wrote Buy Then Build, you know how to buy all these companies, how can we make money off of you? Okay, just as an example. So let's just say I decided to start a fund where we were going to acquire sub $25 million businesses. Okay, so I could go out and raise $100 million, say, and then I could go out and buy 12 to 24 of those companies, and people would be leveraging access into that inefficient market and my track record in that. Okay, so people that are investing in your fund, okay, they really want great returns from your experience and your skilled team's efforts. Okay, they also get preferred returns, meaning in front of you. Okay, some people, even when they start their first fund, They don't even have catch up or anything else. It's just 100% performance based. Okay. And then not only do they get preferred returns, but then there's also, if their team does great, they have this tremendous upside potential to earn um, a outsized gain by taking the risk in this private market. Okay, it's going to be usually patient capital with potentially some cash flow coming, on an annual basis, depending how you set up your fund. Here's a simple payout structure. Okay, very very basic, very high level, but okay. Here's the thing. In this example, okay, the first 8% that returns off the money. Now, this could be a year or per fund or per deal, depending on whether you're using an English or an American style fund. That we're not going to get into that here. But in general, here's the thing. If you get an 8% return on your fund's invested dollars, okay, that first 8% is going to go to the investors as their preferred return. Okay. They put in $100. The first $8 goes out back to them. Okay. Then as you go from an 8% gain to a 10% gain, a lot of times you'll see the management say, hey, I need a catch up. You just made all of the money. So I'm going to go ahead and take a 2% catch up. So the first 8 goes to the investors. The second 2% comes to the management team to sort of help overhead and whatnot. Okay. Then as you go from a 10% total return to 18% total return, okay, the investors have made their 8%, the management team made their 2%, and now the next 8% gain, what's going to happen is it's a 70-30% split in favor of the investors, okay? So again, the management team makes 30% of that cash. And in theory, they've put no money in this example. Usually investors want to see skin in the game on the management team. So there's usually some allocation put in there. But then in this example, once it's over 18%, the management team gets to split 50-50% in those gains as you start to reach those exceptional gains. So as you can see, if you're able to, make 20 or 25% returns on money, okay, then you as a fund manager will be profitable, obviously, right? I mean, you'll make some really good money, especially on other people's money. And your investors will be pleased as punch because they're getting an outsized return compared to, say, just sitting in the stock market or bonds or anything like that. Okay. In short, there's a couple different ways to set up your fund. There's a GP-LP structure, which is a general partner, limited partner. The general partner is the manager or you and your team, usually an entity. And the limited partners are really the investors, okay, that are owners in that entity. Some people decide to structure it not as a partnership, but rather an LLC, and that's fine. There's different class shares. They do Class A and Class B. The investors get Class A, but Class B is really where the managers sit and where all the control sits usually. And then you've got syndication, and syndication, I put in here just because of Regulation A and things that allow for what we see crowdfunding now, right? Like so when you syndicate a deal, okay, whether it be a startup or product, or you're going to syndicate around a film or a particular real estate acquisition, a syndication usually is around one individual deal that you are trying to take out by raising capital around that deal. Okay, so it's not really a fund per se. It is a fund. It's just it's a syndication around one unit, right? One deal. So here's the thing, no matter what structure you do, make sure you get this right. This is absolutely critical, okay? First is just sort of the documentation, right? You've got the private placement memorandum and the limited partnership agreement. Those are the things that are really going to be the governing body of the entire fund that you run, okay? And so every investor needs to sign these. And then you, of course, have the operating agreement, which is going to show, how your fund operates. And so, these things are the things that get circulated. Use an attorney, okay? Please file Form D with the SEC. This is the big one. Please use an SEC level attorney, a specialized attorney, to file Form D. Do not try to DIY this, okay? And then you want to file with each state that you end up raising from, as well, okay? So the benefit is that if you're anchoring in sort of Regulation D, okay, and you're going to file a 506 B or C, we'll get to that in a second. you can actually file all of these things later. Like even after you found the deal, after you raised capital, you can file all this stuff. So we'll get to that in a minute, but this is the part that you really want to get right and make sure that you're in line with the SEC, or else you are operating illegally. Okay, this is not raising from friends and family to do your little startup or take out one business acquisition. This is raising a fund, and it's very, very different. It's regulated by the Securities and Exchange Commission. So when you look at the different types of investors, okay, the SEC discerns between different levels. So non-accredited, accredited, and qualified. Okay, institutional are institutional investors usually are other funds or institutions. Maybe retirement funds or what pensions run by states or whatever. Other people that are trying to make big investments into bigger things. When you get into individuals, though, individuals are either non-accredited, accredited, or qualified. Accredited is going to be the big hurdle here. An accredited investor is someone who makes $250,000 a year, believes they're going to in the next year, or they have $1 million in net worth. Okay, that's what makes an accredited investor. And the SEC says that accredited investors have had some level of success. And as a result, there's two assumptions. One, they are savvy enough, okay, or sophisticated enough to understand investing and deals and can make a knowledgeable decision on whether or not to invest in your fund. Number two, if you do a terrible job and lose some or all of their money, they are theoretically comfortable enough to be able to take that hit. Okay. That's what the SEC says. Tell you what, you are now accredited. You kind of can choose your own adventure. Okay. Below that amount, so if you don't make 250,000 a year or you don't have $1 million in net worth, you are considered non-accredited, and the SEC wants to protect you. Okay, the SEC says, look, you are not, you are not sophisticated enough. You are going to be taken advantage of by these fund managers that are trying to raise capital from you, and we need to protect you. Okay, and so they limit meaning our fund's ability to advertise. They limit the amount of non-accredited investors we can let in, and they limit non-accredited investors in terms of they need to be sophisticated. Okay, and typically what they do is they say, look, you have to have 3 interactions with a non-accredited investor before you're able to even pitch them. Okay, and so these are things that frankly you need to be documenting, things like that. So, if this is like your friend from high school that, you've known for 25 years and, you can pitch them. They know you, they know all the rest of it. If it's someone you met at a cocktail party for the first time, and they learn that you are running a fund, you need to say, are you an accredited investor? And if they say, what is that, or no, then you say, look, we need to have 3 meetings, email, coffee, whatever, before you're able to actually pitch them on what it is that you're doing. Qualified investor is a level above. I've seen that defined as $5 million in net worth or more. And there's certain funds that allow for only qualified individuals. That's really a step above. And then, of course, you've got institutional, which are the biggest players in the space with the most cash to allocate. Okay, so I made this little chart here. I mean, and what we've got here is we've got an XY axis graph. Okay, and what I did was I put the types of investors along the y-axis and the deal sizes that the fund is doing on the x-axis. So at the bottom, you've got non-accredited investors. We've talked about that, sort of, friends and family or not rich people, okay, as the SEC, I guess, would call them. Then you've got accredited investors. Then you've got qualified and institutional, and then you've got this deal size, right? So deal size is not fund size. So funds, as we've talked about, are not raising around one deal. That's really a syndication, okay? So a fund is going to be made up usually of like 12 to 24 deals, okay? And in those deals, you're going to have these different sizes, okay? So you've got a small fund, which might be, less than $30 million. You've got this medium fund that might be, a $30 to $250 million, say, and then you've got maybe over $250 million, or 750 million, which would be considered a large fund, okay? And so, I see a lot of these like $100 million funds out there, and I think a lot of that is, probably not your first fund, but maybe by the time you're getting your second or third fund, you really want to be trying to raise like 100 million, okay? And so the point around the deal size here is that, if you're raising $100 million fund, okay, you might be able to do $5 million deals, okay. But you might be focused on saying, look, this is a $1 billion fund. Like, I can't actually do a $5 million deal anymore. It's too small. I need to actually allocate more funds so we can get a bigger return. I can't have this like death by 1,000 paper cuts kind of situation. And so as the deal size, the targeted deal size of your fund starts to grow, you'll see that the profile of the investors you're going to be going at or pitching is going to change. Okay, so if you're doing smaller deals, obviously, not accredited and accredited investors, are able to invest in these things, right? As you sort of grow, you're going to expand into a qualified, and you might pick off that first institutional um, um, investor. But then as you're doing these really big deals, I mean, if you're doing $50 million deals, okay, you're not going to have someone you met at a coffee shop investing in your fund. You're going towards qualified investors and institutions to back that fund, right? So the types of investors will sort of align with the size of the fund and the size of the deals that you're trying to target. Okay, so then you've got these, Regulation D sort of structures. Okay, we're going to talk about each of these, the 506B and the 506C, that's Reg D. And then you've got Reg A sort of over here, which again is that sort of syndication. It's the crowdfunding, okay, regulation, okay, is what it is. So we're going to touch on it, but really the Regulation D is the 506 B and C. So let's get into that. Okay, 506B. This is the most common structure that private equity funds have. Okay. Number one, there's unlimited investors available to you. So that's accredited, qualified, or institutional, unlimited number of investors. Okay. And it's an unlimited amount of money that you can actually raise. You just have to tell them what it is ahead of time. Then you've got you can bring in 35 non-accredited investors, but like we said, they need to be sophisticated. So you do need to, talk to a lawyer, figure out, what's required there. But the point is that you can't be taking advantage of people is what the spirit of the agreement is, right? They need to understand what they're getting into. A huge benefit of the 506B is that investors get to self-verify whether they're accredited or not. Okay. So could they lie? Of course they could. They could just lie and say that they're accredited. But the thing is that it's not the fund's responsibility; it's theirs. And I've never heard of a situation where a 506B fund that is performing well is getting audited for self-verified status. And even if it does, again, the responsibility of that is on the investor and on you. But here's the rub. The biggest drawback is that you cannot advertise as a 506B. Okay, so these are primarily done via word of mouth. Okay, they're primarily done through networking, through meeting ultra high net worth individuals, other accredited investors, and essentially promising them these outsized returns for investing in your fund. So that's the 506B most common structure. Then you've got the 506C, okay? And what the 506C does is it says that you can publicly advertise. That's the big thing, right? But there's two drawbacks. One, you cannot allow non-accredited investors. Everyone has to be an accredited investor or above, okay? And number two, the fund is the one that's responsible for verifying investor classification. So in other words, if someone's an accredited investor, you need to request whatever, W-2s, tax returns, all the rest of it. I've personally invested in a couple of funds where they've just accepted letters from my CPA, and I'm guessing they were 506C. I really should go back and check because it was sort of this extra step that I had to take. There's also third-party sites now that I've used in instances, but again, I frankly don't know if they were 506B or C. Maybe they were just taking that extra level of carefulness in their investor pool, right? But again, the big benefit is you can publicly advertise. You're just responsible for taking on the verification of the investors. Then you've got this Regulation A, right? Again, this is the crowdfunding thing. You have a limited raise that you can do annually. There's different levels, okay? But I've seen a lot of these where it's like, hey, we can take on, 99 investors. So even like the number of investors is kind of limited based on the minimum investment amount, right? Everything needs to be filed preemptively. So with Regulation D, you can actually raise money before you even create the fund. We'll talk about that in a minute. But with Regulation A, you need to get all your ducks in a row before you go to market. Okay, everything needs to be done and hammered out and ironed out and all the rest of it. You can't advertise, but as we all know, the SEC requires a backbreaking amount of reporting for publicly traded companies. Okay, and Regulation A, I won't go that far, but I will say that the SEC does get up in your business and basically require all kinds of heavy lifting reporting and quarterly reports and all this other stuff that you need to do. And so there's a lot of extra expense in overhead that you need to take into consideration if you're going to go the Regulation A path. 3 steps to success. And this might be counterintuitive or unpopular, but the thing is I always say find a deal first, okay? Don't forget that people are investing in you as a person and probably or your team's ability to find deals with outsized returns. If you don't have a deal or you don't have a track record, okay, it's going to be incredibly difficult to raise money. And so if you actually have a deal and you're now able to also create a sense of urgency for why you need the money and why you need it today. Okay, so that if you can find a deal, you can then turn around and step 2, find investors. Okay, and when you go out and are looking for investors, of course you want them to commit capital to what it is you're doing. But the truth is that you can basically get soft commitments. Okay, and you can say, look, hey, we've got this deal. We're going to be closing it in 60 days. What I need from you, can I count on you for a soft commitment here today? And you're not asking them to invest or wire funds today. What you're saying is can I count on you for this money? Okay. And they might not pull through. But the thing is that if you can get soft commitments, what's happening is you're then able to use that and kind of build momentum and snowball so that you can then turn around later and say, listen, we've got 100 million we're trying to come up with for this deal. I already have, 75 million soft committed. We've got another 25 million. I think it's going to commit over the next 48 hours. Can I count on you to soft commit now so that I can make sure to make room for you? These types of things, right? I'm not telling you to sell something that is not true. I'm just saying that when you create senses of urgency, you're able to figure out where people actually stand on pretty much any deal and whether they actually want to get in or not. Or if you're just burning daylight, need to move on to somebody else. Okay. So we haven't even formed the fund yet. Okay. If you're doing a Regulation D deal, you do not need to form the fund up front. You can find a deal, you can find investors. Step 3, create the fund. Creating the fund, look, it's expensive, right? You've got to hire attorneys, you've got to file with the SEC, you've got to, create an operating agreement and a limited partnership agreement, like all these documents, right? And so the thing is that like if you have a deal and you have the investors, now it's going to be worth, spending the time and money to go through and actually create the actual fund, right? So that's how I sort of think about it. Look, thanks for taking a minute to learn about sort of the high level of how funds work, how to do it, and all the rest of it. One of the things that I want to underscore here is that I know a lot about funds because I used to be in the space. But the thing is I've never raised one by myself. Okay, I've never actually gone out and started a fund. I've come really close a couple of times. Okay, and what's stopping me? Well, the thing is that it works at scale very well. But where I have found success is actually buying companies that I get to own either 80 or 100% of. Okay. And so I've bought a number of companies by using a little bit of cash infusion and bank debt, which is also, by the way, what funds are doing, right? They're raising the capital and then they're going to do like a whatever 50-50, 40-60 split where they're going to go out and raise a bunch of debt to amplify the returns that they can get, as well as the funds that they can distribute. I do the same thing on a small basis, right? So I'm able to buy the company. Now with the acquisition lab, we're now up to 400 members. Okay, we've closed over 100 million in member deals just over the last 12 to 18 months. And the thing is like would I want to start a fund to actually help these people with all of their initial cash infusion? This is something I've thought about for about 4 years or more. And the truth is I can't exactly get it to work in my brain. Okay. You might come up with a different decision. But the thing is that when I think about venture capital, what I know is that 25% of venture capital funds exit and 75% go to zero. 75% of the entrepreneurs that accept funding from venture capital end up going to zero. Okay. This is a VC game and the venture capitals win. The venture capitalists win. Okay. When you look at private equity, the fund managers win. Okay. Hopefully your investors win, right? Hopefully the investors win everywhere. But the thing is that like when I look at what benefits an entrepreneur the most, okay, the business operator, the person that's wanting to build equity in their own venture, okay, it's usually going to be acquisition entrepreneurship because they're able to jump in and buy the company, own a large percentage of it. They report to nobody. They have no investors, right? Maybe you have investors if you decide to go that route and raise up to maybe 19 to 20% of your deal, and then you get 80% in a bank loan for the rest. But the thing is that like because it favors the individual operator so heavily, okay, I have decided, right or wrong, that a portfolio of acquisition entrepreneurs is not something that is best for a fund. Okay. It's something that is best for those entrepreneurs. And so, we talked about Regulation A as maybe a syndication or crowdfunding around those deals. Okay. I started an email list called Search List a couple of years ago, announced it at MIT when I did the keynote there. And we've got about 200 investors at searchlist.com. And right now we have a deal, for example, in the acquisition lab where there's an individual interested in raising capital for his acquisition. And it's off the top of my head, I think it's a $5 or $6 million deal. So he was looking to raise about $1 million, million and a half or so. And it's one of these where with Search List, we're simply making introductions. Okay. So we're able to send out to these investors, hey, here's a lab member. He has this deal. Here you go. And they can, raise their hand and say, yes, I'm interested or not. This is the model that works best in my mind. Whereas if we raised a fund around it and we were distributing all of this cash, it might be something where I would need a large volume of deals. I would need an investment thesis that allows for SaaS companies and home services companies and B2B products companies and whatever. It's just too many different verticals to manage. And the fund would have to be small because you're trying to figure out, okay, how do I deploy, $1 to $5 million deals, which some of these cash outlays might only be, a couple $100,000, right? So it would be a massive amount of volume in a fund. So anyway, I'm going to get off my soapbox, but here's the thing. If acquisition entrepreneurship is something that is interesting to you, please check out the Acquisition Lab. We have, to my knowledge, the largest group of vetted members in our group. We focus on world-class education, resources, tools, and a great community to help entrepreneurs acquire businesses. Thanks so much, and we'll see you next time.